Welcome to The Explainer, where we break down big ideas from the pros. Today, we're diving into a pretty stark warning about the stock market's future, and it's coming from a guy who's been trading for 27 years. So, he's seen a thing or two. So let's kick things off with this quote from market strategist Gareth Soloway. He says, "Anytime I ever take the no-brainer trade, it's usually the trade I get smoked on." And man, that's just a powerful, blunt reminder, isn't it? In the world of investing, the one thing that seems too easy, well, that's usually the trap. And that feeling, it is absolutely everywhere right now. I mean, after this massive everything rally, we're talking stocks, gold, crypto, you name it, a lot of investors are feeling pretty much invincible. But Soloway argues this is the classic psychological setup, the perfect conditions for something to go wrong. And that brings us to the big question we're tackling in this explainer. Okay, so Section 1, a warning for 2026. Soloway's take is that all this confidence out there, it's a classic trap. And this isn't just a hunch he has. He says the charts are basically screaming that a major downturn is getting baked in for 2026. So here's the core of his warning. The charts are signaling some serious risk for 2026. According to Soloway, what we're seeing right now, especially that typical year-end rally, is kind of a mirage. It's happening because trading volume is low, the big players are on vacation, and that's hiding some really serious weakness under the surface. So while everything looks great on the outside, the technical data, it's telling a totally different story about what's just around the corner. All right, Section 2, cracks in the AI hype. So where does he see the first signs of trouble? Well, it's in the AI trade, the very engine that's been driving so much of this market rally. Soloway sees a bubble here, and one that he thinks is already starting to lose air. And this does a great job of showing the conflict, right? On one hand, you have the promise of AI. I mean, nobody's denying it's going to be world-changing technology. But on the other hand, you have the reality of profitability. And Soloway's whole point is that investors are so laser-focused on that long-term promise that they're completely ignoring the immediate threats to profits that are popping up right now. And when you dig in, you see these four big red flags in the AI sector. First, you've got profit margins getting squeezed. Why? Because you have new competitors, giants like Amazon and Google, making their own chips now. That drives prices down. Then there's this accounting trick he points out, what he calls misleading depreciation. Companies are writing off these chips over 7 years, but come on, they're obsolete in 2 or 3. That makes earnings look way better than they actually are. On top of that, you have a massive energy problem. There literally isn't enough power for all the data centers being built. And finally, huge corporate debt. You put all that together, and those sky-high AI valuations, they start to look pretty shaky. Okay, let's move on. Section 3, Bitcoin's ominous signal. So beyond the cracks in the AI story, Soloway's pointing to another indicator he's been watching for years. And he believes it's flashing a major warning sign, not just for the crypto world, but for the entire stock market. And here's the thesis. Bitcoin has this history of peaking 4 to 6 weeks before the stock market takes a nosedive. He basically sees Bitcoin as the ultimate risk-on asset. It's the canary in the coal mine. Because it's where the most speculative, risk-loving money goes first. He argues that when it peaks and starts to fall, it's a huge leading indicator for a bigger market downturn. And this timeline just lays out the pattern perfectly. Look at this. Back in December 2017, Bitcoin peaks. What happens in January 2018? Stocks fall. Fast forward to November 2021, Bitcoin peaks again. And then, boom, January 2022, stocks fall. So, with Bitcoin having already peaked in late 2025 and showing some weakness, well, the pattern suggests the stock market could be next in line. The question mark for 2026 is pretty ominous, right? So how big of a drop are we talking? 40 to 50%. That's the potential correction Soloway is predicting for Bitcoin from its recent all-time highs. Now, that sounds pretty scary, I know. But he actually sees this huge drawdown not as a total disaster, but as a generational buying opportunity. That is, for anyone who's patient enough to wait for it. Okay, so Section 4, a trader's 2026 playbook. Given all these warnings, what do you actually do? How does a trader navigate all this? Let's break down Soloway's playbook for handling the turbulence he sees coming in 2026. This table really lays out the whole strategy. It's a clear shift away from chasing high-growth hype and moving towards protecting your capital. So for Bitcoin, the strategy is to accumulate on the dip. For stocks, it's time to go defensive. Think stable, high-dividend names. And for metals, he's looking for outperformance from industrial metals like platinum and palladium, which tend to do well when there's a lot of economic uncertainty. But when it comes to accumulating Bitcoin, the key here is discipline. This is not about trying to perfectly time the absolute bottom. That's a fool's game. It's about a methodical approach. First, you identify a key technical level, like the old high from back in 2021, around 70K. Then you inch in. You start buying in small, regular chunks. And if it drops further, you just keep outing. This whole process helps manage your risk, and maybe most importantly, it takes all the emotion out of the decision. All right, final section. Section 5, smart money versus market hype. And that whole theme of removing emotion, it really brings us to the core of Soloway's entire philosophy. It's this fundamental battle between disciplined, data-driven trading and just getting swept up by the emotional crowd. Emotion is so intense that the market feeds off of it like a great white shark. Wow, what a powerful image, right? His point is that the single biggest risk to any investor isn't picking the wrong stock or misreading a chart. Nope. It's your own emotional reaction, your fear and your greed, which the market is just ruthlessly designed to exploit. And this comparison really drives home the main takeaway of his entire argument. Hype investing is all about emotion, social media, and those no-brainer trades. Smart trading, on the other hand, is driven by charts, data, and probabilities. It's about managing risk instead of going all in. A sustainable, long-term strategy isn't built on a feeling, it's built on a logical plan. And that leaves us with the final and most critical question for you. Is your strategy built on hype, or is it ready for a shock? You know, as we head towards 2026, it's probably a good time to take an honest look at your own portfolio and just ask, are my decisions being driven by the crowd's emotion or by a calm, logical plan that's actually prepared for the unexpected?